Ever think about where money goes after you deposit it into a bank, or how corporations raise funds for their businesses? This all happens in the world of money and capital markets. These two markets, though distinct in their functions and operations, are the heartbeat of our financial system. They are the invisible infrastructure that keeps the economic machinery running smoothly, enabling businesses, individuals, and governments to manage their financial resources and make investments. Let's take a quick tour of these markets. The money market, as the name suggests, is all about money, but in the short term. It's a marketplace for low-risk, short-term debt securities, with maturities typically less than a year. Participants in the money market, such as commercial banks, central banks, financial institutions, and even governments, use it to manage their short-term liquidity needs. They trade in instruments like treasury bills, certificates of deposit, commercial paper, and repurchase agreements, all of which are highly liquid and low risk. On the other side of the coin, we have the capital market. This is where long-term securities are bought and sold. The capital market is all about raising capital for long-term growth and expansion. It deals with higher-risk, longer-term financial instruments that have maturities exceeding 1 year. Participants in the capital market include individuals, corporations, and institutional investors like mutual funds and pension funds. They trade in financial instruments like stocks and bonds, which carry higher risk compared to money market instruments, but can also provide higher returns. As you can see, both money and capital markets play crucial roles in our financial system. The money market caters to short-term financial needs, providing a way for institutions to manage their liquidity. The capital market, on the other hand, supports long-term investments in capital raising, enabling businesses to fund their growth and expansion. Both markets are interconnected, with the short-term funds from the money market often invested in long-term assets in the capital market. So let's dive into these markets, starting with the money market. Imagine a market, but instead of buying fruits or vegetables, you're buying and selling short-term, highly liquid assets. That's the money market. The money market is the financial hub where short-term debt securities and highly liquid assets are traded. We're talking about financial instruments with maturities of 1 year or less. So the focus here is on low-risk, quick turnaround investments. Now, who frequents this market? You'll find commercial banks, central banks, financial institutions, corporations, even government entities. All these key players are there for the same reason, to manage their short-term liquidity needs, and for investors to park their funds in low-risk, highly liquid assets. What's on the table in this marketplace? You've got treasury bills, certificates of deposit, CDs, commercial paper, and repurchase agreements, repos. Each of these instruments has its unique traits, but they all share common characteristics. They're short-term and come with low risk. The primary function of the money market is to provide a means for these institutions to manage their short-term liquidity needs. It's a bit like a financial pit stop where entities can refuel their liquidity levels before getting back into the race. But it's not just about liquidity management. The money market also offers a parking spot for investors. Think of it as a secure, well-lit parking lot where investors can safely leave their funds. These funds are then transformed into low-risk, highly liquid assets that can be easily converted back into cash when needed. So, in a nutshell, the money market is a crucial component of the financial system. It's the marketplace where short-term, low-risk instruments are traded, providing institutions with a means to manage their liquidity and offering investors a low-risk parking spot for their funds. Now that we've got a handle on the money market, let's shift gears and talk about the capital market. If the money market is a sprint, then the capital market is a marathon. This market is all about the long game. Welcome to the world of capital markets, the realm where long-term securities, those with maturities exceeding 1 year, are traded. Here, the stakes are higher, the risks are greater, and the rewards, potentially more substantial. In the capital market, you'll find a diverse array of players. From individuals and corporations to government agencies and institutional investors like mutual funds and pension funds, each participant has a role to play. Some are here to raise funds for growth and expansion, while others are here to invest, seeking to grow their wealth over the long term. And what exactly are they trading? The capital market is home to a broad array of instruments, including stocks, also known as equity securities, and bonds, which are debt securities. But that's not all. Other financial derivatives and structured products also find their place here, each with its own unique risks and returns. So, what's the primary function of the capital market? Think of it as a facilitator, a conduit that channels long-term capital to businesses. It's a place where companies can raise funds to fuel their growth and expansion, whether it's to launch a new product, expand into new markets, or invest in research and development. But it's not just about businesses. The capital market also serves as a platform for investors to put their money to work. By investing in stocks, bonds, or other securities, they can potentially earn a return on their investments over the long term. And here's a key point to remember. The capital market deals with higher risk, longer-term financial instruments. While the potential returns are higher, so are the risks. That's why it's crucial for investors to carefully assess their risk tolerance and investment objectives before jumping in. So, we've covered the money market and the capital market. But how do these two markets differ? Let's find out in the next scene. Both the money market and the capital market play crucial roles in our financial system, but they have some key differences. If we consider the aspect of maturity, the money market deals with short-term securities, typically maturing in less than a year. On the other hand, the capital market is all about long-term securities, those with maturities extending beyond a year and sometimes even decades. Now, let's talk about risk. Money market instruments are generally perceived as low-risk investments. This is mainly because they are backed by highly creditworthy entities such as governments and large corporations, and their short-term nature reduces the risk of value fluctuation. Conversely, capital market instruments carry higher risk. Stocks, for instance, are subject to market volatility and the performance of the issuing company, making them a riskier proposition. In terms of liquidity, money market instruments are highly liquid, meaning they can be easily converted into cash without much loss in value. This is due to their short-term nature and the high demand among investors. Capital market instruments, however, may not be as liquid. Selling stocks and bonds before their maturity can often result in loss, depending on market conditions. The participants in these markets also differ. The money market is mainly populated by banks and other financial institutions seeking to manage their short-term liquidity needs. The capital market, in contrast, is a playground for individuals, corporations, and institutional investors, like mutual funds and pension funds, who are looking to invest in long-term growth opportunities. Lastly, the purpose of these markets is inherently different. The money market serves short-term financing and liquidity management needs, providing a platform for institutions to manage their cash flows efficiently. The capital market, however, is geared towards supporting long-term investment and capital raising, facilitating the allocation of funds from investors to businesses for growth and expansion. Despite their differences, both markets are integral to the functioning of our economy and the broader financial system. They provide the necessary mechanisms for financing, investment, and risk management, and their interplay allows for efficient allocation of capital across the economy. So, we've journeyed through the markets where the lifeblood of our economy flows, the money and capital markets. Let's recap. The money market, a critical part of our financial system, is where short-term, low-risk securities are bought and sold. It's a playground for commercial banks, central banks, financial institutions, corporations, and government entities. They use instruments like treasury bills, certificates of deposit, commercial paper, and repurchase agreements to manage their short-term liquidity needs. Think of it as a parking lot for funds, a place where investors can safely place their money in highly liquid assets. On the other hand, the capital market is where long-term securities, those with maturities exceeding a year, are traded. Here, the risk is higher, but so are the potential rewards. This market is frequented by individuals, corporations, government agencies, and institutional investors like mutual funds and pension funds. They use instruments like stocks and bonds to raise long-term capital, helping businesses to grow and expand. The difference between these two markets comes down to maturity, risk, liquidity, participants, and purpose. In a nutshell, the money market deals with low-risk, short-term securities and serves short-term financing and liquidity management. In contrast, the capital market handles higher-risk, long-term securities and supports long-term investment and capital raising. The symbiotic relationship between the money and capital markets is key to the functioning of our economy. The money market provides short-term funds that can be invested into the capital market's long-term assets, allowing for efficient capital allocation. So, these markets aren't just abstract concepts, they're the underpinnings of the financial system, affecting businesses, governments, and individuals alike. They dictate how funds are allocated, how investments are made, and how risk is managed. The next time you deposit money into a bank or invest in a company's stock, remember the vital role these markets play. Until next time, happy investing. Happy